and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss recent events surrounding the Fed, banks, and the economy. Specifically, markets have been volatile recently, with the S&P 500 falling 1.6% after the latest Fed announcement. However, it then rebounded over the following days. This recent market activity is a reminder to investors not to focus too much on day-to-day market swings. Instead, it's the underlying trends that matter, which we'll discuss over the next few minutes. First, the Fed announced at its January 31st meeting that it would be keeping rates steady and communicated that a rate cut in March is unlikely. This was contrary to market expectations, which expected rate cuts and up to 5 or 6 in total by the end of the year. Rate cuts, when they do begin, will be a reversal of the rapid rate hikes that occurred beginning in 2022. This chart shows the impact that higher interest rates had on banks. In particular, many banks faced unrealized losses on their bond holdings. As the economy slowed, other cracks started to form, which led to the failures of Silicon Valley Bank, Signature Bank, and First Republic last year. This is once again in the news because another bank, New York Community Bank, reported a surprise loss on its earnings report. New York Community Bank had purchased $38 billion in assets from Signature Bank when it failed last year. Some investors are worried that this could be a repeat of the banking crisis. The situation is still unclear, but signs suggest that these stresses could be bank-specific rather than industry-wide. New York Community Bank has a large concentration of its loan portfolio in commercial real estate, which has also struggled. At the moment, while the regional bank sub-industry of the S&P 500 has also struggled, the broader financial sector continues to perform well. Second, the recent jobs report showed that the underlying economy is still quite strong. This is one reason that the Fed has not been in a hurry to cut rates. 353,000 jobs were added in January, which was far above expectations. The unemployment rate remains at 3.7%, and there are still 1.5 job openings per unemployed person. This is the case despite layoff announcements from large companies. It's important to keep these layoff announcements in perspective, since they tend to be concentrated in tech companies that expanded too quickly during and immediately after the pandemic. Overall, the jobs data shows that information sector still grew in January, and areas such as professional and business services, healthcare, and retail trade grew quickly as well. Finally, it's interesting to note that the VIX index, which is a measure of stock market volatility, is still quite low despite these recent events. Still, investors should always expect the unexpected. The last few years have been a clear example, with unexpected events happening often. Thus, the best course of action for long-term investors is not to overreact to daily headlines. Instead, it's better to stick to a financial plan and a diversified portfolio that can withstand all market cycles. We hope you found these insights on recent events helpful. Please feel free to reach out if you have questions on this or anything else. We look forward to speaking with you soon.